Good morning, everybody. Welcome to Financial Reporting Charity SORP 2026. Just going to pause for a moment, as is the way. We're on 9 o'clock, but you know, finishing coffees, getting coffees, hydrating. Just give everybody a little extra minute to join, as there are people sort of coming through still. So we'll probably kick off at 1 minute past. So just pause for thoughts for a second. Right. I'll start doing a bit of housekeeping, introductions, let sort of any final people join. So as I say, welcome to the Financial Reporting Charity SORP 2026. My name is Dickon Thornley. I'm an audit partner at HW Fisher, part of the Summer Group. So I am in the London-based hub, and I'm going to give a high-level view on some of the key changes of the Charity SORP. We are running further webinars to deep dive slightly more into various areas. We're going to start with a deep dive into leases and revenue coming forwards, but we're also going to look at a deep dive into things like changes in the trustees reports and other areas which have had, quite significant changes in the new SORP. So we will be recording this, so this will go on the website, on the Summer website. There'll be space on the portal, so you can rewatch, or if you have to dip out, then there will be a video. We'll send slides around as well, and obviously the benefit here is for all those that last the distance. We'll send around a sort of certificate for your CPD, so you can claim that you've done your learning here, and it can go towards that year-end piece. This session, as a lot of the sessions, there's an awful lot to get through. There's absolutely, please do put questions in, and I'm just afraid that I might not be able to get to them on this call, but we'll absolutely pick them up in email, respond round afterwards with any questions, and absolutely, if there's more, we can hold even another webinar if there's enough interest or questions about something. So please do drop your questions in. We will get back to them, but unfortunately, with only an hour today, it's unlikely that I'm going to be able to pick them up, respond, and do that in this session. So cracking on then. Welcome. We're going to look at the changes in FRS 102 and the impact on the Charity SORP. So the changes have effectively come into force as of 1st of January 2026. So they will be impacting year-end first, the 31st of December 2026, and for a lot of charities and not-for-profit organisations, possibly means that your reporting will be 31st of March or otherwise 2027. So this is now in effect. Couple of the key areas that we are going to look at high level today are the income recognition, which is aligning FRS 102 and IFRS 15. So this is fundamentally why the changes have come about. IFRS changed their accounting 8-ish years ago now. FRS 102 are aligning to that, and obviously the SORP are reacting and aligning with that and what that means. So an income recognition, we're moving to a 5-step model, a sort of a model that defines everything with a contract, revenue contract, but we'll look at some of the charity specific guidance there. And then similarly, leases, this was IFRS 16 at a similar time. So that's the alignment there. And the key change, which I'm sure everybody's now sort of fully aware, is it's almost doing away with operating lease off balance sheet. Everything comes on and almost is treated like the old finance lease. So everything's there now. What we'll be sort of picking at and looking at is some of the key judgments around both, because it's quite easy to look and assume no impact, but actually underline there could be some situations, and also how you set yourself up to make sure you're ready from an operational point of view through the year, but ready for your year-end auditors or year-end accounts, and those judgments have been made way before the end of the year. Also looking at other changes in the SORP, picking up a couple of these. So tier system, we'll just be touching on that. Trustees report, as I say, it's quite a lot going on there. We've held some really interesting conversations. We hosted some conversations with Charity Finance Group and other charity sort of forums discussing the impact on that. There's been some really interesting sort of comments there. So I think we'll look at some of that shortly, but we'll probably spend an entire session on that later in the summer or early autumn, deep diving into some of those changes there. Going concern, a little bit more guidance, revenue recognition, lease accounting. We're going to really sort of touch on those during this session. Statement of cash flow, so some potential burden sort of lightening there. Provisions, contingent liabilities, and heritage assets. So some real sort of changes coming about. So just kind of pick up on a couple of those, spend maybe sort of 5-10 minutes looking at some of these ones before we get into the revenue and lease accounting. So what we're talking about now is a tier system, a 3-tier system. The SORP is then helpfully laid out the expectations of what the impact on each tier, so you can see it by tier, what is mandatory and what is sort of suggested and considered good governance, I suppose, in reporting. So we've got tier 1 that's currently up to 500,000. That effectively stays the same. Tier 2 is currently up to 500,000, but we're now talking up to 15 million pounds now for tier 2, with tier 3 being over 15 million pounds. So kind of bringing in a bit more clarity on, I suppose, reporting under what would be in corporate worlds of large, medium, small entities. In SORP world, we've got tiers 1, 2, and 3. And then in there, as I say, the SORPs are now very prescriptive in each of the modules within it, which tier it applies to. There are things that are obviously mandatory for tier 3 that are recommended for tier 1 and 2. Obviously those recommendations you don't have to do, they are recommendations. But yeah, this is some of the key impacts, and obviously falling into those tiers, and that certainly that bigger tier 2 does mean that there's potentially slightly less onerous reporting requirements. So there's positivity, don't get me wrong. A lot of charities wanted to see it go a bit more, but this is where we're currently at. So specific differences for different tiers, I think where it's going to pull out, if you looked into the SORP yourselves and had a look, it's probably modules 1, 4, 8, 9, sort of 14. These are areas where it's kind of very sort of specific about things you have to include, things you have to consider, but and it is slightly different depending which tier you fall into. So you've got the trustees annual report, obviously statements of financial activities, and all these other bits. I won't read through them for the sake of time, but those are the key areas where there are sort of differences depending on which tier you fit in. Some of those, so if we're thinking about trustees annual report, and just as I say, really high level, picking apart some of the key changes. So there's new and enhanced disclosure requirements, and there is some quite significant ones. Picking through that is, that's reporting on how a charity is responding to and managing environmental governance and social matters. So it's encouraged for tiers 1 and 2. So encouraged, it's you can, and they'd love to see you do it, but not mandatory. It is mandatory for tier 3. Impact reporting. Now, this is an area where, with the Charity Finance Group, we had a huge level of debate on how to measure, how to record, how to describe the impact reporting. This is now impact reporting is now mandatory for all charities. This is, this is going to be quite big. And what is the impact on the things that you're doing as an organization? So that will potentially require a little bit more thought, a little bit more work, a little bit more writing in that front end, and that's for all charities. And there we've got at the bottom tiers 2 and 3 should provide more narrative on how legacies are recognized in the account. So a little bit more disclosure. Again, the sort does go into them a bit more, but then it's those ones around the environmental governance, and I think the impact reporting is a really important one to sort of start considering early. How are you able to record that and I suppose sort of measure it as well? And there's some real, it's not necessarily easy depending what you do as an organization, so there can be some real challenges and some real judgments there. So other updates, other areas, as I said at the beginning, going concern, there's a little bit more prescription, there's a little bit more guidance on what good looks like, how to prepare, and what a going concern basis is. So I think that's great, really helpful. Cash flows. So only charities in tier 3 are required to by the SORP to produce a statement of cash flows. So that's great. That's up to 15 million now, so 50 million plus. But just be careful, depending on the type of organization, whether there is a charitable sort of company there. Charities in tiers 1 and 2 are required, or potentially required, to prepare a statement of cash flow. So just have a look over. So I think great news for the SORP, and hopefully reduces some of the burden and the reporting burden. But if you also need to report under FRS 102 and those sort of pieces, there are potential requirements there. So it's not necessarily that unfortunately for some there'll be a requirement to still produce a cash flow statement. So do think about that. More clarity on heritage assets, and then finally there's I suppose a little bit, again, clarity is probably the way to look at it on provisions and contingent liabilities. But I think translating that and talking about that and what does that mean and what are the differences, we might again run a sort of shorter module or combine it within that to give you a little bit more flavour there. But heritage assets, provisions and contingent liabilities, there's certainly some more clarity in the new SORP. Going concern, more clarity. I think it's that cash flow one. On the outset, it looks great, but just be careful in case you are caught by FRS 102 requirements. So that was a whistle-stop tour of some of the changes, especially impacting trustees' reports and the overall financial statements. We managed to cover it in about 6 minutes. As I say, I've sort of chaired courses that have lasted 2 hours debating it. So we will go into it further, but do start thinking about it. Really, I think start talking about with other stakeholders as well within your organisation. Certainly about that impact reporting. I think that's going to require a lot of thoughts, and it's going to require a lot of input on what is to be said and how things can be recorded. But for the remainder, for sort of the next sort of 45 minutes, we're going to spend our time looking at some of the key fundamental changes in income recognition and lease liabilities. So we'll start with income recognition first. So the key changes is the first sort of starting point is thinking about exchange transactions and non-exchange transactions. So the exchange transactions, which is where goods and services are provided in return for payment of some sort. So you're exchanging something, so you're providing goods or services in order to get economic benefit. Or non-exchange transactions, so these are more likely to be your donations, some of the pure grants, there are, you know, grants in there. Some of the depending on grants and what you have to produce for those grants, you know, they may be exchange transaction, possibly some research, all those kind of things. But non-exchange transactions, so you could get certain grants where you're not expected really to provide anything back. You are getting a grant to continue your operations. Donations, you're not providing a goods or service back beyond obviously the charity being able to continue and do what it does. So first and foremost, thinking about exchange transactions and non-exchange transactions, because now under the new SORP, those exchange transactions become quite critical. This is where the 5-step model is really going to impact. So currently, it's relatively simple: exchange of services at a point in time, provision of services over time, using stage of completion is the expected revenue recognition at this moment. New approach is effectively, it's a unified approach for all income. There is the assumption all income is received under contract. Now, absolutely in brackets there, we've got implied or otherwise. You are not about to start writing up necessarily and draw up contracts for every single item. You know, if you thought in a shop, if you had a sort of shop that's helping with the charity, you know, before someone buys an item of clothes, you're not going to quickly draw up a contract, get them to sign it yourself, and then make the transaction. There is an implied contract with those when you're making the purchase. So but it is under the guise that all income is received under contract now, and that contract is treated in a 5-step model. So again, this is around your exchange transactions. You know, the non-exchange, now those are basically treated in the same way, but you know, your exchange transactions now under contract, now under a 5-step model. So what does that mean? These are the 5 steps. So you identify the contract, you identify the performance obligations written within that contract, then you identify the contract price, you allocate the price to each performance obligation, and finally you recognize income when each performance obligation is met. So as it is met, you will recognize that income. Now, a lot of this possibly very straightforward. It's you are in theory doing it all at the same time. As I say, it might all happen at once. So going back to my shop scenario, if you've got a shop outlet, that's probably the easiest one to sort of give an example to. But if I was to go into a shop and buy an item of clothing, say from the shop, taking it to the till, and presenting the item of clothing, well, there is an implied contract there. We'll get into the sort of definitions in a sort of second. Identify the performance obligations. Well, selling the item of clothing is going to be that. Identify the contract price. Likely is that there is a price tag on said item of clothing. Allocate the price. Well, that price tag is for that item of clothing. It's all very, very simple. 111. You recognize that the performance obligation is met. Well, once I've bought that and got the item of clothing, you are recognizing income. So all of that can happen in the space of the 30 seconds I'm at the till. So, you know, some of this is just in there, but you have to now consider it as part of a 5-step model, but all of those steps might happen very, very quickly. So step 1, identify the contract. Contract has been approved by both parties. How do you know you've got a contract in place? How do you identify? So it's got to be approved by both parties. Each party's rights can be identified. The payment terms, again, can be identified. And the contract, and this is really key, has commercial substance. There's a real underlying commercial rationale for doing the transaction that you're about to do. Some items may fall out of that, so that really is key there. Probably the entity will collect the consideration it is entitled to. So again, It seems simplistic, but yeah, absolutely. Are you likely to get whatever the consideration is, the good, the services, the payment, the cash, and then once you've done that, if you meet all of those kind of things, you've got a contract in place. So, in my very, very sort of vanilla example, me presenting, that item of clothing at the till, well, the idea the sell is going to be approved by both parties. Someone's sitting at a till waiting to sell, I'm looking to buy. The rights, the payment, all of these things can be identified. Hopefully, I've got my card out or my cash. You know that you're going to get consideration. So that's step one. Thinking about all of those things, it can be a little bit judgmental. We will deep dive into these, think about things where maybe, there isn't commercial substance. Maybe this shouldn't, isn't considered a contract. Those terms aren't met, and you will have to sort of pause and consider that impact. Step two is identify the performance obligations. So a performance obligation is a promise in a contract with a third party to transfer to the third party either a distinct goods or service, or a bundle of goods and services, or a series of distinct goods and services that are substantially the same and with the same pattern of transfer. So it is that distinct goods or service. So we talk about if it is distinct, if both of these are met, the third party can benefit from it, either on its own or together with other resources, i.e. capable of being sold separately, for example. And that's an important, and it's not an or, it is separate from other promises in the contract. So can you separate it out? So can you benefit from it, but can you separate it out? Can you use that separate to any other promises in the contract or any other sort of dealings in the contract? And we'll get through some worked examples later on, but it is that idea. You might be providing a service that, maybe it's a combination of services. You're sort of doing a training, you're doing selling some goods, or doing other things that the organization provides. Now, that training, can the third party benefit from it on its own? If you're just delivering that training, does it need anything else that's in that contract? Or actually, can you benefit from that training on its own? Is it separate from doing training to, say, also providing branded goods? It's not a great example, but you could sit there and go, right, well, actually, we've said we would provide training. We've said we would maybe offer up our logo or use of charity status on the website or something like that. Can they be separated out? So you've got maybe more than one performance obligation there. So you might agree to an overall price for all of that, but you're thinking, right, actually, there are performance obligations. I've got to deliver training. I've got to deliver some goods that I've said that we would to deliver. I've got to let them utilize my logo or sort of on their website for 6 months. There may be a number of different obligations that you've committed to in one go. Then step three is determining the transaction price. Now, again, these are all on your exchange. Yes, Jackie, I think we at the beginning we will share our slides as well, so that these will be coming. But yeah, so we're determining the transaction price. What does that look like? So the transaction price is what is the amount of consideration to which the entity expects to be entitled in exchange of transferring goods or services promised to a customer. It's excluding amounts collected on behalf of third parties. Now, effectively, vanilla, you could have the price tag on an item you're selling in your shop, but you will have an agreement. So you're determining the transaction price. There are, again, this is on your exchange transactions, your non-exchange transactions, you're treating it sort of separately. There are some additional considerations. Maybe there's variable consideration in what you're offering. If the third party buys a number, you might give discounts or something later on if they buy a certain quantity. So there may be variable considerations. Are there returns? If you've got a shop as part of your charity, an organization, is there the right to refund and return? What are those? any kind of sort of royalties or rebates. You know, if you've basically got some licenses, I work with some not-for-profit organisations that have licenses as part of their sales, and that sort of goes in. So thinking about that, and also the time value of money. You know, if you've sold something today, but you've going to only receive payment in 6 months' time, a year's time, what is the actual time value of money? You're basically, what if you're not receiving that cash straight away, it's probably not worth as much as if you receive that cash today. So you need to sort of think about potentially discounting that down. FRS 102 does talk to it. So, you know, I think the SORP is what, 300 pages now. And within that, you also cross-refer to the FRS 102. So there's a lot of reading to be done. Look at that. But within their variable consideration, there are, you know, I've just talked about discounts, refunds, rebates. Are there any bonuses? Are there any penalties? I think the sort of key here is you can or should take into account some variable consideration, and that will be based on expected values or the most likely outcome. So it can be if you deliver a service, and you'd get an extra 10% if you delivered it before a certain time. You know, at that point, what is the most likely outcome? Sorry, are you going to produce? Are you going to deliver that service before, or not? And if you think, yeah, the most likely outcome is going to be we're going to deliver it by that point in time, well, then we should be recognizing that extra 10%. Expected values, you know, maybe going back to that example of rebates or sort of royalty incomes and things like that. Maybe if you offer a rebate, if someone's bought a certain amount or done a certain amount, then, you know, you would have your expected value. You know, where at this point in time, you will revisit it, where do you think you're going to end up? So those are kind of the considerations. You'll use that one method consistently throughout the contract, and you only are including an amount of variable consideration to the extent that it is highly probable, and you will then obviously update any estimates at the end of the contract. You will take into account any changes from there. So can be step 2, the transaction price and defining the transaction price could be very vanilla, could include variable considerations and otherwise. So, you know, there may be some judgments around that on these exchange transactions. Step 4, allocating the transaction price. Again, it's straightforward. Well, this seems very obvious. You know, I want to buy something, you're selling something, or you're providing a service that I want. Allocate the, you know, there's the price, allocate it to that transaction, simple as you like. Where you've got to think about this, and, you know, and I think a lot of charities have had, you know, benefits of thinking about this with certain grant treatments, you know, in the past, you know, thinking about milestones. I think probably not-for-profits are slightly ahead of the curve on this compared to the corporate side. But that allocating that transaction price, if you had a bundle of performance obligations, you might have 3. Going back to my example, that you might be providing a service, you might be providing training, you might be then providing some merchandise, and you might be providing your the ability to use your logo on their website for 6 months or something. There might be 3 different performance obligations, and you've charged £10,000, you know, for all of that. You bundle it up. How do you then allocate that transaction price? Because you've got to allocate it to each performance obligation. So allocate in proportion to standalone selling prices. Now, again, we don't have time to get into the full detail here, but this is the idea that if you are selling training individually, that might be that it's £10,000. If you were selling merchandise, it might be that it would be £1,000. And if you were selling the use of your logo on a website, that might also be £1,000. So individually, you sold each one, it would come to £12,000, but you're offering it for £10,000 for the sum, for the bundle. So you then might allocate it out proportionally to its standalone price. So, you know, if you've got 5/6 would normally go to the training, you'd put 5/6 of your £10,000. So you'd separate it out in that way. So allocating the transaction price can be very, very simple. If you're selling one thing, one item, it's got a price, it's, you know, it's a price tag, then brilliant, allocate it out. Otherwise, you know, you're going to have to allocate it in proportion to standalone selling prices, thinking about how you might allocate it out. So again, possibly once you've established there's maybe more than one performance obligation within this contract, in this exchange transaction you're entering into, and looking at the type of services you provide, maybe there are more. Now you're going to have to allocate that, and now you're going to have to rationalize how you're allocating it to each performance obligation. Recognizing income, step 5, the end game here, you would recognize it at a point in time or over time. This is, you know, in simplicity, this is as performance obligations are met. So at a point in time, a third party obtains control of the asset. Indicators for that are, you know, charity has a present right to receive payments, third party has legal title of whatever the asset is, third party has physical possession of the asset, or you've provided the required training, so therefore they have the asset. So all of these things, once those are there, you'd recognize that income at a point in time. Over time, there might be something that, you know, is you're providing for a period of time that can't be recognized at that particular point in time. So you're going to recognize it as over a period of time, and things like that, where the third party simultaneously receives and consumes benefits, and as you're providing, they're receiving and consuming those benefits. So, you know, there are sort of pieces here that could mean that actually you need to kind of consider, you know, how much will it cost overall to provide these services, and therefore a proportion of that you'd measure the revenue accordingly to account for it over time. So you've got the sort of two options there: a point in time and over time. Conscious of time as a slide stage way, so we're just looking at the practical challenges, because we're going to move on to the leases, because again, it might be that the leases are likely to have a bigger impact. I think the revenue one, I will stress, a lot of conversations I have with clients, a lot of conversations, you know, I have around the sector, most people are sitting there thinking, doesn't apply to me. Now, that might be the case. You do have to relook at the services. You do have to look at each revenue stream that you're providing. What are you actually providing in exchange? Make sure that sometimes, you know, you are providing different items to the same client. So actually, maybe you are providing a bundled sort of services that need to be split out, need to be considered, need to have the transaction price allocated. But if it doesn't, if you're, you know, being audited and those things, you still have to have created a paper that shows your working, shows what you've considered, why it doesn't impact. But your impact will still be, you need to update your accounts and disclosures for the 5-step model. Things will now be, you know, done under that. The reference points and the terms in maybe your policies internally now need to reflect that 5-step model rather than maybe what it's saying at the moment. So there is potentially some internal sort of pieces and updates there. Some of these practical challenges, you know, budgeting, if it does impact you, the likelihood is, if this impacts you, that revenue will be recognized over a longer period, and therefore reducing some upfront revenue. That is the likely output of all of this, and that could have a real impact on your budgeting. It could have an impact on potential covenants if you've got any sort of loans or otherwise, performance related pay if there is any of that. But, you know, KPIs, external communications, suddenly if your revenues dropped, you know, do the wider stakeholders know about it? Have you considered, you know, what that impact is? You don't want to be going to your board meetings and suddenly revenues down in the year, perfectly reasonably, but is that what, when you're looking at your forecast for the following year, when you're talking to stakeholders, do they know about it? Are they aware that there is potentially going to be a drop in revenue purely because of a change in accounting policies and where you're going about it? So, think about those things, making sure you're updating those and thinking about, legals, marketing, sales, all of those sort of items. How are you going to do it? How are your systems ready? So possibly quite a few practical challenges to think about, but as I say, don't dismiss that it's no impact to you. Start, if you're very confident in that, document it down, go through those notes, have it there written, take that to the board, make sure they're comfortable that you've made that assessment, you've made that judgment long before your year end. But do think about either which way your disclosures will have to change, your accounting policy will have to change, you'll have to align to the new 5-step model and those disclosure requirements. So there will be change, even if it might not fundamentally change the day-to-day revenue recognition in your organization. So lease accounting, we've got the current lease accounting, the distinction between an operating lease and a finance lease. So operating lease is off balance sheet. You've got that disclosure at the back of your accounts of what your commitments are over the next year, 1 to 2, 2 to 5, those kind of things. You've got that in the back, and it comes in as an expense in the year. So that is currently how it's looked. Finance leases, on the other hand, recognized as an asset with a corresponding liability. So that's the current sort of format. Gone is that current format. No distinction between operating and finance leases. There are exemptions to this. There is things to think about within there, but the key fundamental is now that there is no longer this differential. All operating leases are now on balance sheet with a matching liability and asset, sort of offsetting those. So that is the fundamental change. This is quite major, quite significant, and is likely to hit a lot of organizations. I say it all clearly at the bottom there: exemptions available for short-term leases and low value assets. Now, what do we mean by this? The SORP and FRS 102 been a little bit more helpful, a little bit more prescriptive than when IFRS 16 came in. But short-term leases, lease terms of 12 months or less, and contains no purchase options. So very simply, if you can get out of your lease in 12 months or less, so when considering it for your first year, you might be coming to the end of a 5-year lease and you've only got 8 months left at the end of the year. Well, that is considered a short-term lease, even though initially it was a longer-term one. So you might sort of take that expedient and consider that as a short-term lease, but effectively anything that's going to be under that 12 months is considered short-term. You then don't have to bring that on balance sheet. There is additional disclosures at the back end that you would have to include, which are similar to the operating lease, but it does mean that you still have to monitor, make sure you've got those listed out so you can identify those short-term leases. So those are one of the key exceptions. Low value assets are the other ones. I think when IFRS 16 came out, there wasn't a huge amount of guidance. What does it mean, low value asset? If you're a large charity, that could be, actually, without being flippant, some of the sort of smaller items, you could be considered immaterial from a materiality point of view, in that respect. A car worth £20,000 might be a low value asset if you're a charity that's worth £30 million. However, that's not the way to think about it. It's not based on your own materiality. It's based on the asset by asset. FRS 102, they have given quite prescriptive examples. Example just given, car, trucks. That is not considered a low value asset. The person on the street doesn't consider a car a low value asset, despite you maybe being a very large organization. So you have to consider it. You have to think about it. As I say, without putting some words in, I helped a lot of companies transition under IFRS 16 at the time. $5,000 was considered a kind of a bit of a benchmark. That was maybe things worth less than that were maybe low value. There is no formal valuation that is, has been prescribed to go, this is a low value asset. It is a judgment that you will have to define. You'll probably, make sure you run past your trustees and boards to make sure that they're comfortable with your decision on what a low value asset is. Probably speak to your auditors early to make sure they're happy that you've considered it. But there's a judgment to be made there. As I say, the standard is quite good on prescriptive sort of pieces of what it considers aren't low value, such as cars and some other items. But once you've got to that low value consideration, you've made that judgment, it can therefore be exempt from bringing on balance sheet. That's sort of the standard saying, don't worry about bringing those on, and they will then be considered in a separate disclosure. So do keep tracking of them. Don't suddenly buy a low value asset and then ignore it somewhere, because you will have to just keep track. There is a disclosure required, but you don't have to bring it on balance sheet. Where not-for-profits and charities are likely to have a extra consideration over corporate colleagues or other organizations is around peppercorn and social donation leases. So peppercorn leases and social donation leases. This is what we're talking about here, is arrangements under which the charity pays nil or only a nominal amount of consideration, as known as peppercorn arrangements. So this is, if you are sitting, in an office that is provided for you, that's a very, very, very low value or no value, but that is considered a peppercorn lease. So here, the guidance we're talking about may have that legal form of a lease. It is unleased, but it is unlikely to meet the definition of a lease under FRS 102, as the payments due are likely to be very small, or there are no payments at all. So in this case, any payments are made are treated as an operating expense, and they're outside of this scope of 20 of FRS 102, but section 10. So this means that you've got to think about, maybe it doesn't form a lease, maybe it doesn't meet the criteria under this module, but it potentially then does meet the criteria under donated goods and sort of facilities and services. So there is potentially then a revenue aspect that now needs to be considered and brought in, if not done already. So you might have a lease agreement, it might formally be there legally, you've entered into a 5-year lease at basically that peppercorn rent. Just because you've signed the contract doesn't make it a lease, and it might not be that it's treated under this section, but actually should be treated under module 6 and thought about as revenue. I think here we're sort of talking about using the information that's readily available when you're coming to some of these decisions about what potentially is a social donation lease. And when we're talking social donation leases, which we'll get a worked example shortly, this is maybe where it's not peppercorn, it's not absolutely free, it's not nominal, it's maybe at a discounted market rate. So you may be paying 75% of the normal market value. So there is some sort of social donation in there, you are getting benefit. So you've got to consider the information available, and then you have to value the incoming resources from the non-exchange component. So you are potentially, if you're getting a lease at 75% of market value, you are potentially therefore getting 25% in a non-exchange component, is and that is got to be considered when looking at your leases. So there is a little bit more in this within the peppercorn and social donations. A lot of my clients, a lot of people I've worked with over the years, they get some office space, they get allocated certain part of the office, and they've not really been paying rent. They may have an agreement that they can use certain amounts, it's kind of there, been there in the background. Excuse me. Now got to think about it. Now got to account for it. So in this example, we are sort of talking about the lessor states that as part of its corporate social responsibility activities, it will give the charity 50% discount on the office space. So the charity will pay £60,000 per year for the office space. So what does that mean? Just, it's the lessor is giving 50% discount. So in theory, it would normally rent the office space for £120,000. The charity, the organisation, is getting it for £60,000 per year. A key consideration, though, is if the arrangement had not been available, the charity expected to pay £72,000 for office space elsewhere. So this is absolutely critical when considering what is that social donation where potentially there is a non-exchange transaction happening. Is, as a charity, as an organisation, you were never going to spend £120,000 on rent. That's, whilst in consideration, you would have shipped around, you had seen another office space that was only £72,000. You were eyeing that one up, and then lo and behold, this landlord offered it at £60,000. So perfect, you were taking it. So it's about what you would do rather than simply you are getting a £60,000 discount, because you would have never rented that space for £120,000. You'd have gone elsewhere. You'd have got a cheaper deal. So what does that mean? The information available to the charity indicates there is a non-exchange component in the lease. You are getting benefit, you are paying rent, but you are getting benefit outside of that. Where the charity determines that it is a facility it has received under this arrangement, it is the value of the charity to the charity of the office space that is important. The non-exchange component is £12,000 per year. So what does that mean? Why are we there at £12,000? We're charging we're being charged £60,000 instead of £120,000, but we ignore that £120,000 because if we weren't there, we'd be going somewhere else and paying £72,000 in a different office. So actually, what we're benefiting from is that £12,000. So the difference between the 60 and the 72 we'd pay if we went elsewhere. So that's the difference between the value to the charity and the payment being made. So it's the value to you, and and this again is something that you might have to start thinking about, providing some evidence for what else could you get if you weren't paying there, and it's got to be a comparable piece. It can't suddenly be, well, there's a one room place 100 miles from where we are now, and that's distinctly cheaper, so actually there's no exchange. You've got to think about it in terms of what you're getting, where else you could go, and would you reasonably have taken that. So again, if this sort of type of contract resonates with you, do start thinking about, actually, fine, we are getting a big discount, but actually if we hadn't got a big discount, we would have gone elsewhere and paid X amount. It might be that actually the discount you're getting is a market rate discount. That is, if you'd not got the discount, you wouldn't have been able to go elsewhere for any cheaper. So actually the discount's great. So just start thinking about that. There is judgments there. There is evidence that you'll start having to put together to support your considerations. So assuming no performance related conditions exist in the arrangement, the charity will recognise the income when it is received or receivable. So that's that £12,000. This will usually be at the commencement of the lease, but maybe over time, over the term of the lease, depending on the terms and the arrangement. So it's this non-exchange. So thinking about, you've got peppercorn, you've then got a social donation lease where you are paying rent, you're paying a good value of rent. It's not complete nominal value, but there is clearly a non-exchange transaction. You have to separate out the two. You have to think about those, and then you have to recognize that non-exchange. Think about module 6 rather than under leases. So potentially for everybody, and that's the obvious one we've used here is rental, but don't forget there may be other assets and other items and services that you are being provided that maybe fall into this category of sort of a social donation lease, and therefore, is it peppercorn, is it social donation, is it just is it a lease at all? So there are things, and you do now need to go and look at those contracts, make sure that when you've got those contracts in place, don't just assume, look back, is there any sort of differences and changes there? So that's, I think, quite a key one, and a real sort of differentiator when I'm talking to clients, and how that, there are very, very few corporate organizations that will be, falling into this sort of piece. So really worth thinking about there. Again, I think hopefully what I'm hammering home here, we are only the 20th of May today, but there are discussions here, there are judgments being made by the finance team, by people on this call, that you need to document out. Your best bet is also to run these past trustees if there are significant judgments, simply making them aware. But also, these are potentially big judgments. You probably need to get some sort of approval, get it through and review. So start thinking about it. What are your plans? How are you creating capacity to be able to look at all of these? If you've got a number of leases, if you've got a number of sites, you've got a number of assets, it might not just be buildings. That there are other things that you might be getting benefit of. Have you considered them? Relook to the contracts, which ones are leases, which ones aren't, what do you have control over? So a lot to think about. Please don't put it off, because it is recommended that A, you think about it, document it, but B, present it to the trustees, present it to boards as you go. Make sure you've got that approval, and ultimately, the earlier you can provide it to your auditors, or where you need assistance, from external, you might not have the bandwidth. You might be a very small finance team that actually running the day-to-day is a lot. So getting the help you might need. So do think about it early. We're just going to spend the last sort of 10 minutes just thinking about the measurement with a little worked example. So lease liabilities. Now we've considered whether we have a social, donation lease, whether we have peppercorn lease. If we've just got a vanilla lease liability, how do we recognize that? How do we measure that? We are going to look at the lease liability. It's going to be measured at the present value of the future lease payments. Now, when we go into this, we will certainly not have time to cover all of this in 9 minutes. But there are lots to think about there. You've got your fixed payments, but any variable payments, what are you accounting for? Is it going to go up by CPI over the 5 years, 10 years of your lease? If it is a measured, variable payment based on an index, then absolutely you need to include that. You need to make the assessment. It might be a sort of a judgment of what you think CPI might be over the next 5 years, but you can include that. If it is a variable consideration that isn't a variable payment, isn't matched against an index, you cannot include that. You can't, again, without sort of thinking on the top on where sort of scenarios like this lie in sort of corporate, or maybe within sort of retail space, you might have amounts based on sales transactions, numbers provided, something like that, and it may fluctuate dependent on that. You can't include that because you don't know. It's not based on an index, so those are ignored and treated on an annual basis as and when they arise. Other bits, payables under residual value guarantees, price to purchase, all of these kind of things. So that may impact your measurement, but what you'll then do is you will discount it down to your current present value of any of those future lease payments. So if you've got a 5-year lease, you will, and it's X amount, £100,000 each year, you'll take that £500,000, you'll discount it down to a present value, and then that's unwound over that period of time. But there are a lot of judgments in there, a lot of considerations. Your right of use asset, on the other hand, if it's a very vanilla contract, is quite straightforward. You might just have a simple situation where the initial measurement is the lease liability. So once you've created that current net present value of future lease payments and got that liability, your right of use asset, it's just the same. It matches that. You've got the two numbers. Your balance sheet is hugely bigger, or potentially largely inflated, but net impact is at that initial point is maybe zero. There are other pieces that you need to think about within the right of use asset. So initial costs incurred, you add those in, potential estimates for obligations of cost to dismantle. So we're talking about dilapidations here, an area that has been often ignored at the start of contracts, dare I say, hard to value, but actually now it needs to be considered as part of your initial right of use assets. So that'll be brought on, and that sort of liability and then that asset will be brought on at the start and then unwound over that period. So there are other aspects that can impact your right of use asset, but under fundamentally, if you had a very vanilla contract, your lease liability is going to be matched by your right of use asset. So subsequent measurements, and as I say, this is very much a high level, trying to fit it all into an hour. This is just trying to get you to think about it, make sure you're preparing yourselves. It may take some time. There are lots of things to consider. We will be running other webinars that sort of look into this in more detail. I think they're coming out over the next couple of months. So in those, we'll work through some more sort of physical worked examples, get into a little bit deeper some of those other judgments that you'll start having to document and consider. It's a little bit more complicated, or can be, depending on the contracts, than simply the operating lease methodology. So lots to consider, but subsequent method in this situation is when you've got a lease liability, you're going to reduce the lease payments. So it might be going back to my £500,000. I've got £100,000 a year for 5 years on my lease. I've created, and without the maths, I've created a net present value of £450,000, which I'm then going to unwind over that 5 years. So that will reduce. That will reduce by the £100,000 payment each year, but you're then going to increase that liability by the unwinding of that net present value, that unwinding of the liability, to eventually get to and match off to the 500,000. So there's two things going on with the lease liability. There's an unwinding and your simple cash payments. That unwinding, though, importantly, that is now a finance cost. How you unwind that's going in as a finance cost. So suddenly that's going to be a new area in the income statement. There's going to be a finance cost there. Your right of use asset, it's now an asset. You are going to depreciate that asset over the term of the lease. So that's going to be but you can measure it cost or revaluation, but the likelihood is it'll be at cost and depreciated over the life of the lease. But because it's an asset, you are going to have to consider it and document your consideration for impairment purposes. So is there any reason why maybe you're looking to move out, other sort of areas? Will you need to impair that asset? So it is now a matching asset. Sure, there is a liability, but you do need to consider it as though it was a standalone asset. So every end of year you will start to think about, absolutely, is there an impairment to that asset? But otherwise it's sort of depreciated over the terms. It's a lot more straight line. What does that look like? So try to create a worked example. We haven't gone into how you calculate your discount rate. There can be, that's going to be a huge judgment. We've created a situation here which is a very, very vanilla example. It's a 4-year lease, £10,000 per year payable in advance, and we've got a discount rate of 6%. So ignoring other variables, ignoring all those other pieces, this is where we've got it's a sort of a vanilla contract. So you can see that initial recognition, £36,730. That is the net present value of future lease payments. That's where we've got those £40,000. We discounted it back using that 6%. We will go into details on how you get to your discount rate, but get your 6%. Your initial is, there's a right of use asset, £36,730. There's a liability. Your net balance sheet, net nil, but obviously inflated. What does that mean? Year one, though, and this is where it starts to change. Year one, you'll have that interest expense. That's the unwinding of the liability. As you increase that liability back up to your £40,000, you're unwinding it. There's an interest expense, a finance expense coming in. The depreciation expense, so again, it's coming in as depreciation now. That's your right of use asset being depreciated. You can see it evenly over the 4 years. It's being depreciated there, getting unwound there. That's how the expense is coming in. You used to have this old operating expense coming straight in, but now you've got this depreciation and you've got this finance expense. And you can see On the balance sheet at the bottom there, year one, there is now a difference. You've got actually a bigger liability than you have asset. So over the period of the time, you might start equal, but there is the potential that you can then separate out, and that could create differences in your balance sheet. The implications to that is, what does that mean? You know, it could be that, again, covenants, other sort of KPIs, performances, how you're sort of doing, how you're tracking, what does it look like to readers of the accounts, to other stakeholders. There can be quite significant differences here because of this treatment, how it's coming in. You're suddenly going to have finance expense. You know, that's going to be, you know, different places on the cash flow if you're at a tier 3. So a lot of changes that could come about because of this. It is quite fundamental. There's a lot of judgment. There's a lot of consideration that needs to be done before you get to this. But this is just a little bit of a show how to get there. So wrapping up, it's 10 o'clock. Most people have held firm for the time. So thank you for staying with us. I am very conscious it's very high level. That is why we're going to run future webinars. It's very hard to get into the detail on all the changes in the space of an hour, but trying to keep them bite-sized. So we'll be running those. Messages will be coming out over the next few weeks, setting up new webinars where we'll look in more specifically income, leases, trustees report. We'll look at some of these in much more detail, much more worked examples to try and help you through. But do start thinking about it now. Reach out to your advisors if you need support. It's something you want to start working through now. There can be quite significant judgments, estimates, and implications. Otherwise, 10 o'clock. Have a lovely day, guys. Thank you very much for joining. Any questions, we'll get back to you. Any other questions, please do reach out over email and contact us. Thank you all for joining.